Last video, I told you that you were being hunted, that your stop losses are liquidity, that the levels everyone watches are exactly where the traps are set. But I did not show you how to see it. Today, that changes. I am going to show you how to read liquidity like the professionals do. Not theory. Not abstract concepts. Actual tools you can use tomorrow. Welcome back to Axiom Capital. Data over emotion. Let us start with something most retail traders never look at: the order book. You know that chart you stare at all day? That is just a history of what already happened. The order book shows you what is about to happen. Think of it like this. The chart is a movie of the past. The order book is a window into the present. So what does it show? On one side, buyers. People willing to buy at specific prices. These are called bids. On the other side, sellers. People willing to sell at specific prices. These are called asks. The gap between them? That is the spread. And the spread tells you something important. Tight spread, lots of liquidity, smooth price movement, widespread, low liquidity, danger zone. Where most traders never look at this. They just look at candles and wonder why price moves so weird sometimes. Now, not all order books are equal. Sometimes you see thick walls of orders. Thousands of shares stacked at a price level. That looks like strong support, right? Be careful. Those walls can disappear in a second. They are often fake, placed there to make you think there is support, then pulled right before price hits them. This is called spoofing. It is illegal, but it happens constantly. So how do you know what is real? Watch how orders behave when price approaches. Real liquidity stays. Fake liquidity runs. If a big wall disappears right before price touches it, that was a trap. If it stays and absorbs the selling, that is real demand. This is something no course teaches, but it is how professionals read the market. Here is something that might bother you. Most of the liquidity in the market you cannot see. What? Yeah. The order book only shows a fraction of actual orders. Big institutions do not show their hand. If a hedge fund wants to buy 1 million shares, they do not put that order on the book for everyone to see. That would move the market against them. Instead, they use hidden orders, iceberg orders that only show a small piece. Dark pools where trades happen off the public exchange. So that order book you are looking at, it is like seeing 20% of the picture. The other 80% is happening in the shadows. This is not to scare you. It is to make you realistic. You are playing a game where you cannot see most of the cards. So stop pretending you can. And start working with what you actually know. Liquidity is not constant. It changes throughout the day. And knowing when it is high or low can save your account. When is liquidity highest? Market open. The first hour of trading is chaos, but it is liquid chaos. Lots of participants, tight spreads, Fast execution. When does it drop? Oh, midday. Lunchtime in New York. Things slow down. Spreads widen. Moves get choppy and random. When does it pick up again? Last hour before close. Big players make their final moves. Volume spikes. And when is it most dangerous? After hours. Pre-market. Holidays. Low liquidity means your stop can get hit by a random spike that means nothing. Most traders ignore time of day. Professionals plan their entire strategy around it. There is one more thing you should be watching: volume. Not just is volume high or low, but where volume happens. When price moves on high volume, that move has conviction. Lots of participants agreed on that direction. When price moves on low volume, be suspicious. That move can reverse fast. There is no real commitment behind it. Here is a practical tip. When price breaks a level, check the volume. High volume break, probably real. Low volume break, probably a trap. This alone will save you from so many fake breakouts. And it takes 2 seconds to check. Most traders watch price. Smart traders watch price and volume together. Because volume shows you where the real liquidity is participating. So let us bring this together. You now know that the order book shows you live supply and demand. You know that big walls can be fake, and you need to watch how they behave. You know that most liquidity is hidden, so stay humble. You know that time of day matters. Trade when liquidity is there. You know that volume confirms real moves. This is not magic. This is just paying attention to things most traders ignore. And when you start seeing these things, you stop being surprised. You start understanding why price does what it does. Not predicting, understanding. That is a very different game. Look, I know this is a lot. And if you are new to this, it might feel overwhelming. But here is the thing. You do not need to master all of this overnight. Just start noticing. Open your order book. Check volume on breakouts. Pay attention to time of day. Small changes. Big difference. And wait, there is one more piece to this puzzle. Who is on the other side of your trades? Who provides all this liquidity? Who profits whether you win or lose? Next video, we talk about market makers, the invisible players behind every transaction. If this helped you see something new, drop a comment. Tell me what you are going to pay attention to first. Subscribe for the next one. Data over emotion. I will see you there.